There's a reason this matters more than you think. That shooting star candle everyone's freaking out about on silver's chart, it's telling two completely different stories depending on who's interpreting it, and one of those interpretations is about to cost a lot of people serious money. I'm watching supposed silver experts lose their minds right now, declaring the rally dead, the bubble burst, the top confirmed. Meanwhile, institutions are positioning themselves in ways that directly contradict what they're telling retail investors through their media channels. Let me show you what's actually happening beneath the surface. Silver closed Friday with what technical analysts call a shooting star. Long upper wick, small body near the bottom appeared at what looks like resistance. Textbook bearish reversal pattern, right? The kind of formation that gets plastered across financial Twitter with warnings about impending crashes. And predictably, the retail panic began immediately. Here's what the bearish camp is screaming about. Silver spiked above $34. For the first time in over a decade, hit a wall of selling pressure and collapsed back down. That upper wick represents buyers who got absolutely destroyed, trapped at higher prices, now sitting on losses. The shooting star supposedly signals that buyers have exhausted themselves, sellers have taken control, and the path of least resistance is down. Classic top formation, they say. Get out while you can. Several mainstream analysts are already drawing comparisons to 2011, when silver hit $50 and then crashed 80% over the following years. They're pointing to overbought RSI readings, parabolic price action, excessive bullish sentiment, all the typical bubble indicators. The message is clear. This is the top. History is repeating itself. Anyone still holding is about to learn a painful lesson. Now let's look at the other interpretation, the one institutions aren't broadcasting. That same shooting star appears after silver broke through a 13-year resistance level on massive volume. The price didn't just test $34, it smashed through decades of overhead supply, triggered every stop loss and breakout order in existence, then pulled back to consolidate. This is where everything comes together. What looks like rejection to retail traders often represents institutional accumulation masked as weakness. Here's the critical context most analysis completely misses. Silver's float is microscopically small compared to the capital now chasing it. We're talking about a market where $50 billion would move prices violently, where physical supply constraints are already showing up in delivery delays and premium explosions. When you understand the actual liquidity situation, that shooting star looks less like exhaustion and more like absorption. Let me break down the volume profile during Friday's session, because this is where the real story lives. Silver opened around $33, immediately pushed to $34.70 within the first 2 hours. That's a nearly 5% intraday move in a metal market. Massive volume came in at those highs, not the declining volume you'd expect if buyers were actually exhausted. Then the reversal, dropping all the way back to $33.20 before stabilizing. The bears see capitulation. But look at the volume distribution. The heaviest volume didn't occur at the top during the sell-off. It concentrated in two specific zones, the initial breakout above 34 and the recovery zone around 33.40 during the afternoon session. What makes this significant is, when prices were at their lows of the day, volume should have spiked if retail was truly panicking out of positions. Instead, volume increased as prices recovered, suggesting institutional buyers were stepping in at predetermined levels. This matches exactly what we're seeing in the futures market positioning. The most recent Commitment of Traders report, which reflects positioning from earlier in the week before this shooting star formed, showed commercial hedgers reducing their short positions to levels not seen since 2019. Let me be clear about what this means. Commercial hedgers are primarily mining companies and industrial users, entities that typically short silver as a business hedge. When they're reducing shorts aggressively, they're either decreasing production expectations or they're finding better risk reward and letting physical inventory appreciate rather than locking in futures prices. Simultaneously, large speculators, the managed money category, increased longs but not to extreme levels. We're nowhere near the speculative excess that marked the 2011 peak. Back then, managed money net long positioning exceeded 90,000 contracts. Currently, we're sitting around 55,000. There's enormous room for additional speculative interest before we approach historically frothy levels. Let's pause and consider the fundamental backdrop, because technical patterns don't exist in a vacuum. The Federal Reserve's balance sheet remains above $7 trillion despite all the quantitative tightening rhetoric. Real interest rates, accounting for actual inflation rather than the manipulated CPI figures, are still deeply negative. Every Treasury auction sees weaker foreign participation, forcing the Fed back into being buyer of last resort. These are not conditions where precious metals form sustainable tops. Then we have the geopolitical overlay that's completely absent from the bearish shooting star narrative. The BRICS nations aren't just talking about de-dollarization anymore. They're actively building the infrastructure. Saudi Arabia is pricing oil contracts in yuan. China and Russia settled bilateral trade in their own currencies, bypassing SWIFT entirely. Central banks globally added over 1,000 tons of gold to reserves last year, the highest purchases since 1967. Silver moves with gold in these macro shifts, but with a volatility multiplier that creates opportunities and risks magnified beyond what gold investors experience. Here's something almost nobody is connecting. The green energy mandates hitting in 2025 and 2026 require silver in quantities the market cannot supply at current prices. Solar panels alone could consume 200 million ounces annually within 3 years. That's roughly 25% of total mine supply being absorbed by a single sector. Add electric vehicles, 5G infrastructure, military applications, and the supply-demand math becomes absolutely strained. Above-ground investment inventory is already depleted from the 2020-2021 retail buying surge. The SLV ETF had to ration redemptions during peak demand. Mints can't keep pace with fabrication needs. These are not symptoms of a market topping out. These are symptoms of a market in the early stages of a structural shortage. So we've got bearish technical analysts screaming about a shooting star reversal pattern, and bullish fundamental analysts pointing to supply constraints that will take years and significantly higher prices to resolve. Who's right? The answer depends entirely on your time horizon and what you believe about the broader monetary system. If you believe the Federal Reserve will successfully engineer a soft landing, reduce inflation to 2% while maintaining economic growth, and restore confidence in fiat currency, then yes, silver probably topped. That shooting star represents the end of a fear-driven rally, and prices will revert to industrial demand fundamentals around $20 to $22. But if you believe we're in the terminal phase of a debt-based monetary experiment where central banks have no choice, but continued currency debasement regardless of inflation consequences, then that shooting star is noise inside a much larger pattern. A brief pause before the next leg higher in a bull market that could run for years. This is significant. The interpretation you choose reveals what you actually believe about the system, not what you claim to believe. Most retail investors suffer from cognitive dissonance here. They'll acknowledge the debt is unsustainable, the Fed is trapped, the dollar is dying, but then they trade silver like it's just another commodity following normal technical patterns. They see a shooting star and bail because some analysts said so, despite nothing changing in the fundamental thesis that made them buy initially. This is the same pattern we saw in March 2020 when silver briefly touched $11, $78 before rocketing to $30 4 months later. Same pattern in September 2022, same pattern in December 2023, but the playbook never changes because it keeps working. Retail investors have the memory of goldfish and the risk management of degenerate gamblers. Now, let me address the elephant in the room. Some of you are thinking, if this was so obvious, why didn't everyone just buy the dip? And that's the sophisticated part of the trap. It wasn't obvious in the moment, when you're watching your account balance hemorrhage in real time, when every news outlet is confirming your worst fears, when the technical indicators are screaming, sell, courage becomes almost impossible. The institutional players understand human psychology better than most psychiatrists. They know exactly how much pain triggers capitulation. They know which price levels hold the most stop-loss orders. They know that retail investors make decisions based on emotion while pretending it's logic. Think about that for a second. Every single metals takedown follows the same psychological pattern. Initial decline triggers concern, acceleration triggers fear, media confirmation triggers panic, and right at the point of maximum pain, when it feels like the bottom is falling out, when selling feels like the only rational decision, that's precisely when the reversal happens. And the cruelest part? Even investors who understand this intellectually will still make emotional decisions in the moment. Knowing the pattern exists doesn't make you immune to the psychological pressure. That's why the same trap works over and over again. The institutions don't need to fool everyone. They just need to fool enough people to create sufficient selling pressure to trigger the stops and liquidate the over-leveraged positions. Once that cascade begins, even the people who know better often get swept up in it. So here's the alternative interpretation of last week's price action. Major institutional players needed to cover short positions ahead of a price advance they knew was coming. Physical demand was already strong and accelerating. The fundamentals for higher silver prices were firmly in place. But short covering into a rising market is expensive and reveals your position. Solution? Engineer a coordinated sell-off to trigger retail panic and stop-loss liquidations. Let the algorithms pile on with momentum selling. Let the media amplify the fear narrative. And while everyone else is running for the exits, quietly cover your shorts at favorable prices and potentially flip to long exposure. Then, once the retail selling is exhausted and the weak hands are cleared out, let the natural buying pressure reassert itself. Step aside and watch the price recover while everyone who sold is now too traumatized to buy back in. You've covered your shorts at a discount, you've potentially established new long positions at artificially low prices, and you've eliminated a wave of competing buyers who won't return until the trend is obvious again. We haven't even begun that compression phase yet. If we simply return to the historical average of 65, silver reaches $40, while gold stays flat. If silver outperforms the way it typically does in bull markets, driving the ratio to 50, we're looking at $60 silver. Here's something I find fascinating about did the silver bubble burst? The truth about today's shooting star. Candle. These ratios matter because they represent centuries of market behavior, not technical patterns from the last few weeks. What makes this significant is the timeline we're working with here. Silver doesn't move in straight lines even during powerful bull markets. The 1970s bull market, which took silver from less than $2 to $50, had multiple corrections exceeding 30%. Traders who panicked during those corrections missed the ultimate gains. The 2003 to 2011 rally had similar characteristics. Massive gains interrupted by violent pullbacks that shook out weak hands. If we're truly in a new bull market driven by currency debasation and supply constraints, a pullback from $34 to $30 or even $28 wouldn't invalidate anything. It would simply represent normal volatility in a volatile asset. Here's where I'm supposed to tell you what's going to happen next, give you specific price targets and timing. But anyone who claims to know exactly how this plays out is selling you something. What I can tell you is what I'm watching, the indicators that will clarify which interpretation is correct. First, the $32 level. If silver holds above 32 on a weekly closing basis, that suggests the breakout is legitimate and the shooting star was just a temporary exhaustion spike. If we close below 32 for consecutive weeks, especially on heavy volume, that would indicate the bearish interpretation has merit and further downside is likely. Second, the dollar index. Silver's move happened despite dollar strength, which is unusual and bullish. If the dollar begins weakening from current levels, silver could accelerate higher rapidly. If the dollar breaks above 110 and holds, that would create significant headwinds for precious metals, regardless of other factors. Third, real yields. The 10-year TIPS yield is hovering around 2%. If that declines toward 1% or lower, precious metals historically respond very positively. If real yields push above 3%, that would create a legitimately challenging environment for silver. Fourth, physical market indicators. Watch premiums, delivery times, and inventory levels at major dealers and ETFs. If these continue tightening, it confirms the supply thesis regardless of what paper prices do short term. If premiums compress and inventory accumulates, that's bearish. Fifth, institutional positioning in the next COT reports. If commercial shorts increase dramatically, that's a warning sign they see prices as extended. If managed money longs contracts significantly without price follow-through, that suggests strong hands are absorbing their selling. The implications are clear. That shooting star everyone's obsessing over is a Rorschach test revealing your underlying beliefs about monetary systems and market structure. Bears see it as confirmation that silver got ahead of itself, retail speculation drove an unsustainable spike, and reversion to industrial demand fundamentals around $25 is coming. They point to technical patterns, overbought conditions, and historical precedents like 2011. Their case requires believing central banks will successfully navigate away from inflation without triggering recession, and that supply constraints will resolve through normal market mechanisms. Bulls see it as a momentary digestion of a major breakout, institutional accumulation masked as weakness, and the early innings of a multi-year bull market driven by currency debasement and structural supply deficits. They point to physical market tightness, central bank behavior, geopolitical shifts, and secular demand trends. Their case requires believing the monetary system is breaking down in ways that benefit hard assets regardless of short-term technical patterns. Both camps have evidence supporting their view. Both camps have intelligent analysts arguing their case. Both camps could point to historical examples that validate their interpretation. The difference is the bears need technical analysis to be more powerful than fundamentals, need sentiment indicators to override supply and demand, need past patterns to reliably predict future outcomes in completely different macro environments. The bulls need fundamentals to eventually overwhelm technical patterns, need supply constraints to manifest in price regardless of paper market manipulation, need the monetary endgame to play out in ways that protect hard asset holders. Which worldview you find more credible determines whether that shooting star terrifies you or excites you. Here's what I'm doing, and I'm not giving financial advice, just sharing how I'm approaching this exact situation. I'm treating that shooting star as information, not instruction. It tells me buyers and sellers disagreed violently at $34. It tells me momentum stalled temporarily. It doesn't tell me the bull market is over unless you believe single candlestick patterns override everything else. I'm using any significant pullback as an accumulation opportunity, with defined risk below $30 on a sustained basis. I'm not leveraging positions because silver's volatility can wreck even correct directional bets with poor timing. I'm focusing on physical accumulation and mining equities with strong balance sheets, not trying to trade every swing in spot prices. I'm prepared for this to take years, not months, to fully play out. Bull markets in precious metals move slower than crypto or tech, with longer consolidations and more false breakouts. Patience gets rewarded, impatience gets destroyed. Most importantly, I'm not letting talking heads who panicked over a candlestick pattern convince me to abandon a thesis based on structural fundamentals that haven't changed. The shooting star matters, but it matters far less than the supply deficit, the monetary debasement, the geopolitical realignment, and the industrial demand tsunami coming at a market unprepared to handle it. That's the truth about today's shooting star candle. Not a simple bearish reversal, not a guaranteed continuation, but a moment of price discovery in a market transitioning from decades of suppression to potentially years of revaluation. How you interpret it reveals whether you're trading patterns or positioning for systemic change. And in case you're still unsure which interpretation makes more sense, ask yourself this. When is the last time institutional media and mainstream analysts wanted retail investors positioned correctly for a major move? They're screaming about that shooting star for a reason. Maybe that reason has nothing to do with protecting your portfolio,